And welcome to the VSA Capital Tech and Transitional Energy Podcast. It's Thursday, 29th of June, nearly halfway through the year. Of course, we've got all those companies that are struggling to get their figures out with calendar year ends. And for some reason, they can't get them out within 6 months. I find it extraordinary the way companies leave it to the last minute. Surely 6 months is long enough to get your figures out. I know there's a problem with a lot of auditors, etc., who just don't seem to have the capacity to do all these companies. But for goodness sake, guys, you know what? There's 40% less companies listed on the London Stock Exchange than there were in 2008. Surely enough of you out there charging enough money to be able to get these people's figures out. I think a lot of the problems do lie with companies who are just slow to do it, and then they try and rush it all at the last minute and realise they don't really know always half the time what they're doing. But there you go. That's oh, hello, Phil. Are you on there?
Yeah. Hey, I'm here, Andrew, and I was just thinking about all that wonderful accounting software that's out there to help these companies. No excuse.
Yeah, maybe they should. I'll tell you what, though, VSA, of course, the biggest news this week was the RNS from VSA giving our year-end profits. Our year-end actually is March, so we got them out in under 3 months. In fact, we probably could have got them out a little bit quicker, but we like to release at the end of June. It sort of suits us for a whole host of reasons. They were, of course, record figures. The outlook was cautious, slightly more cautious than it was last year. We still expect to make a profit for next year, unlike most of our peer group, which is struggling because these markets are horrendous. But I do think, for now, I've just been having coffee with another firm, and I do speak with a lot of the CEOs around town, and I think we're all feeling that, actually things have got so bad. There is just no money in this market. The pension funds, insurance companies, they're all out of equities. Something has got to give. And I was also told an interesting one is that, one tweak they could do that would actually transform the market. You know what? They set up all these lovely PEPs and ISAs or whatever. I forget which one we do at the moment. And you get all this tax-free money. But apparently something like 80% of all the ISA money is actually in US equities. So why not change the rules and just say you only get your tax-free if it's in UK equities? It would bring billions into the UK market. Just a thought.
Well, as an ISA holder, it's a good one.
Well, it's bloody sensible, actually. And I'll tell you the other thing was something a bit, this week, nothing to do with tech and trends, but everyone's talking about obviously Thames Water, how it could go into collapse. Do you know what? I don't know if you know this, but 71% of all the English water companies are owned by foreigners. And the problem with Thames Water is classic PE. What PE do is they come along, they gear everything up with massive amounts of debt, rip out all the cash and give it to themselves. And then they don't care if it goes bust. And of course, Thames Water is actually owned by overseas companies, basically. It's owned by CIC, the Chinese Investment Corporation. It's owned by the Ontario Pension Fund. It's owned by a bit of Abu Dhabi. The only English owner in that Thames Water is USS, University Superannuation Fund. But that's what they do. Private equity, they don't care. They're just financial engineering, and yet all this money is pouring into private equity. The only people who make money out of private equity are the private equity players themselves. The government's got to clamp down on it. It's not helping the country at all. At least in equity, money goes into the companies. They don't over leverage. The shareholders are basically the people of this country, because it's their pension funds, it's their SIPs, their ISAs, all this sort of stuff. For God's sake, government, please change the rules. Anyway, right, nothing of a rant. I nearly always start with a rant anyway. More to follow, maybe all of that. Let's start. I'll tell you what, let's just run through to start with. I think there's been some news out on some of our corporates this week. So we should probably just talk about them to start with. And of course, our favourite, but take my word, this thing is getting a real head of steam, and it is going to go ballistic. I remember back in the 90s when I was pushing ARM, a lot of people kept telling me, nah, it's not going to work. No one wants RISC chips. Mobile phones won't happen. Silicon's going to be replaced. This company has all that sort of stuff thrown out. I'm telling you, this is going to go ballistic. It's Invinity Energy Systems. Now, I woke up on Sunday morning and nearly cracked open the champagne because the Midas column, which is probably the most read column of all the Sunday newspapers, Joanna Hart, she's a very astute woman. There was a whole page basically on Invinity Energy Systems saying buy. But then we also followed on, didn't we, Phil, this week with their full year figures. So you might want to just touch on those a bit.
Yeah, well, it's vanadium battery flow batteries for the grid. So the whole energy storage space, as we've spoken on many an occasion, is growing globally at a significant rate. The company's commercializing its products now, and had its full year results, said that they closed sales of 39.2 megawatt hours of systems in 2022. And that was up from about 1 million megawatt hours in 2021. So quite significant growth in their sales, but they're seeing sales growing internationally, which I think is catching a lot of attention, particularly with California Energy Commission in the States, with partners in Asia, but also in the UK as well. So it's now for the business, it's all about commercialization, about momentum, about growing its customer base. And, as we know, it was pretty well funded as well early in the year with a £23 million equity fundraise, not a debt fundraise. And they're also advancing development of their Mistral product, which is going to be a higher margin battery and openly competing with lithium there. So quite exciting scaling news of the business. Great to see that coming through.
Let me tell you the little gems in it, all right? They say into it they are still talking to strategic partners and hopefully bringing one in. To be able to say that in your reporting accounts, you have to be very, very confident it's going to happen. So, guys, it does look as though it's going to happen. Another strategic, they've already got one, Everbright. Looks like another one's coming in. That will give the shares another uplift. Other little trick of this, you'll see they've repriced the warrants. The warrants to December the 16th now of this year, 50p. The stock's trading at 43p. The warrant is only trading at a penny. That warrant is probably worth at least 5p, if not 10p at the moment. So you go in and buy the warrants. The only problem is you'll struggle to get any volume. But if you can get hold of any, they are very valuable. And it's the geared way of playing this. That is the trick to play. A couple of other things I'll tell you. The International Flow Battery Forum, which is a huge thing that takes every place with all the flow batteries talking, it's just taken place this week in Prague. Next year it's going to be in Scotland, which is great. But a lot of things coming out of that, I think you'll find. And the other thing I'd point out to you is that one of their competitors in zinc flow, EOS, if you look at their stock price performance over the last few months, it's gone from $2 to $5. The Americans are getting this. That is why I'm actually doing a US roadshow with Invinity at the back end of August, early September, visiting numerous US cities and Canadian, because it has got an OTC quote, and we are going to get the Americans buying this like there is no tomorrow. So there you go. That's enough on that one. Let's talk through. I'll let you do it. Maybe there was a little bit of news out on Equipmake at the start of the week, wasn't there?
Yeah, there was actually. Oh, you reminded me of that one now. Yes, they are partnering with a Swiss-based electric aerospace developer called H55. And Equipmake, ticker is EQUIP. Is it Equip? Yeah. And anyway, it's listed on Aquis. About 90 million market cap, based in Norfolk, and they develop very advanced electric motors for transport. So that's for heavy transport, automotive, marine, and electrical aerospace. But what kind of caught my eye about this is that they're already working with Vertical Aerospace in the States, were listed, based at Bristol, on electric motors for flight. And this technology is an early stage, but it's coming. But the key thing here is that Equipmake's motors are so power dense, compact and lightweight, that they're being potentially used in aerospace applications. So it's more of a verification, validation there of their tech, I think, and just how advanced their electric motor tech is. So I thought that was really interesting.
Yeah, and then the other corporate that had numbers this week, it was Interims. They'd only just recently had their full years again caught up in the audit process. But nice news, CFO, who we were very impressed by, was Pressure Technologies, wasn't it?
Yeah, that's PRES is the AIM ticker. Very well established UK engineering group. Chesterfield Cylinders is the core business. It's been around for over 100 years. But they make, it's very the enormous cylinders that can withstand very high pressures, up to 750 bar. Your car tires are 2 bar of pressure. And the main markets for them are, of course, defence, in submarines, compressed air systems, but also in oil and gas industry. And they have a machining business as well, that machines wear parts for the oil and gas industry, for valves in particular. But yeah, they had their interim results, Andrew, and the revenues were up by 45% to just under £14 million. Gross profits up by 3.7 million, and they moved into an EBITDA profit. And a lot of this has been driven by the defence-related business, and particularly the supply of cylinders onto the Dreadnought new class of nuclear submarines that's being built, but also for overseas as well. So yeah, nice to see.
Well, it was, but the market took a rather negative reaction. I think for two reasons. They've had a couple of slightly weak months, but they were still forecasting a nice EBITDA for the full year. Hey, we all have a couple of bad months. We do at VSA, take my word. But also, people got their knickers in a twist about, the Lloyd's banking debt, which is at 1.9 million. They seem to forget they brought it down from 15, and 1.9 is, frankly, is nothing. I'm staggered actually that Lloyd's haven't just said, yeah, fine, we'll renew it. We've been up there. This is a huge business, and it's actually a very, as you said, it's been around 100 years. A market cap of just £13 million is absolutely ludicrous. I know that Schroders are very supportive. They have a major shareholding there. We know that Peter Gillenhammer has now come in. We know that he can support it as well. You've got get it in a second. Richard Harwood and something pretty thick here. Harwood Capital. It's his own name. They're in there with a big stake. You've also got people like Premier Asset Management, Aberdeen Asset Management. This is a quality company. I mean, look, I know we were buyers higher up through our picks and shovels concept. I do own it personally. I'll be absolutely honest with you. I think it's a great company. The market has completely misunderstood it, and it is a buy at this level. I'm looking forward to your research note if you're going to write one, Phil, because I'm sure that'll have a buy on it. Don't say anything you're not allowed to.
No, I was just going to say I couldn't possibly do that. But all I would also add in there is, at the end of the day, it is all about, for any business, about the quality of the orders and the order books. And bear in mind, this is 13 million market cap. They had order intake of £34 million during the 8 months to May. So anyway, do have a look.
It's great. Look, I mean, one of the reasons, the other reason the share price is down is these markets are horrific. They really are. There is zero liquidity in these markets. Everything is just going down. You only need to sell £10 worth of stock and you'll knock a company 10%. It is horrific. I mean, I've been doing this game 40 years now, and this is probably one of the worst markets I've ever seen because there is zero liquidity. It's just vanished. It's nothing to do with the valuations. It's all to do with the liquidity. Anyway, there's been quite a lot of figures, I think, out this week, Phil, a reasonable number, I think. So why don't you run through a few of them?
Well, yeah, as you say, all the companies have been getting kind of results out towards it before the end of June. This one here wasn't. This was Marlowe PLC, which I must admit I hadn't looked at before. Ticker's MRLM, and it's 570 million market cap. The shares are up 28% year to date, but we'll talk a little bit more about that. They're their full year to March. And Marlowe, this is software, Andrew, and they're involved in software to regulatory markets, compliance markets, and what they cite as business critical services. So it's governance, risk and compliance, testing, inspection, certification, etc. Now, the shares in this company had fallen post its interims. It's been very acquisitive. And it's acquired 10 acquisitions during over its last sort of more or less financial years, it said, and invested £44 million in acquiring. And its revenues has increased up to its interim period, but the market was getting pretty worried about its gearing, the level of debt in the business, which increased from 109 million in March last year to 156 million in September. And obviously, they reported that in November, and this at a time when interest rates were rising. Anyway, it has reported its full year results now, and just looking at the figures for the business, I mean, bear in mind it's been acquisitive, so you all got to look at the figures, their turnover closely. The turnover was up 47% to £466 million, but 47%. But remember, it's been acquiring. And I was more interested in looking at the organic growth. The organic growth, the underlying business, was 10% growth which they said was ahead of prior guidance. But also the thing we are always looking at, especially if a company is geared and carrying debt, is the cash generated. And it generated from its operations. Cash generation was up by 120% to £74 million. And that's on turnover of 466 million. So very strong cash generation. And the net debt figure closing was 161 million pounds, which they said was a little bit lower than previous guidance. But given that cash generation, I've not looked in detail at interest cover and everything, but I'm not surprised at the market turn on it and want to be looking at. It's just the first time I've seen this one.
Interesting.
There we go. So that's Marlowe, and that is broadly held by institutions. So, positive news from Marlowe. Onto some bad news, and that was Tiny Build.
Oh, the market didn't like that, did it?
Oh, blimey. The ticker's TBLD. The market cap, when I last looked, was £71 million, but it's down 77% today. Good, blimey. It's so video games publisher and developer. And this is not a space I must admit I widely followed, which is bloody old. But anyway, it's what was quite a few things came out of this were interesting. I mean, firstly, they published 70 titles across different genres, so a lot of titles of games there into the market. And of course, there's big competition in the market. But what they've said is that the first half performance was below expectations due to contribution from platform deals, underperformance of various games. But they're expecting a acute reduction in their adjusted EBITDA in 2023 and 24. So that was not good. Reduced cash position expectations of $10 to $20 million versus $26.5 million. But I thought what was quite interesting was a comment here. As witnessed across the industry, distribution platforms have been significantly downsizing the amounts of investments for non-AAA games. Now, I don't follow the sector, but I assume that AAA games are sort of big popular ones, and platform deals have been an important driver of growth, etc. So, but anyone following the games industry, I thought it was quite an interesting statement of the industry moving. Particularly when you've got the Microsoft, the Activision bid going on for, and that is a AAA platform. Yeah, but not good news there for gaming.
Yeah, I don't know whether just gaming gets squeezed as well, presumably by the consumer cash crisis, because you could probably afford not to buy the next latest game, just carry on playing the last. I mean, Grand Theft Auto is the only one I know. I mean, God knows how many of those they've released, but you could just play it over and over again. I thought. Anyway, there you go. What do I know? I don't play these games. Carry on, Phil. I know.
Right, there we go. So Interseed, again, software, ticker is IGP. This is that 30 million market cap. And it's cyber security. And they specialize in digital identities and so authentication technologies. And they've got the customers in government, aerospace, defense. And I'm always interested in companies that have been around for a long time, because they tend to be able to adapt their strategy over time to markets. And this one's been around for 20 years, so it'll have a pretty well established customer base. And they reported they look like it's March full year results, I think, but their revenues are up by 22%. From just under 10 million to 12 million pounds, and their net profit was up from 0.71 billion to 1.3, but it's got cash on the balance sheet of 8.3 million, up from 7.8. So it's pretty well funded, doing well in the current markets. And just looking at the multiples on it, it's on EV/NR ratio of 1.5 times, and EV/EBITDA of 20 times fallen to 15, which means the forecasts are out there for earnings growth. So that to me looked quite a reasonable thing to look at.
Talking of little ones, I saw I think it was interim from Cloud Coco today, Mark Halpin's little vehicle. Did you look at that at all?
Yeah, I did. Yeah. Sales up.
He's doing all right, actually, isn't he? I mean, the stock's off a bit. It's a very small cap company, but it looked all right to me.
Yeah, the ticker's CLCO. Yeah, it's only about 8 million market cap, but it's cloud services. But no, the organic revenue was up by 11% to 12.9 million. EBITDA from 0.5 million up to 0.9. But, again, it's about winning business in the current environment. And they said that they won 27 what they call new logos, but new clients during their interim period, which was 70% of the number signed in the whole of the previous year. So, yeah, doing pretty well given all the the economic background and for customers as well.
Yep.
Which is what you want to be looking at, because
Oh, sorry. Yeah, when companies.
I was just going to say, when environment's tough and a business is doing well, when the environment gets better, it'll do really well. So that's why we're talking about some of these companies. CML Microsystems, which has been listed for many years. It's a fabulous semiconductor company. So it designs chips. They outsource the silicon manufacturer, and then they do their own testing and ship them out. But CML Microsystems, ticker is CML, it's about 70 million market cap. They develop what are called mixed signal radio frequency microwave semiconductors. So these go into the communications markets. So things like they go to satellite comms, machine-to-machine communications, Internet of Things. So they reported their revenue, so full-year results to March end. The revenue was up by 22% to £21 million. Profit from operations just under £5 million. Profit before tax of £5.2 million, with cash of 22 million. So, and I know that they divested of a division, memory chip controllers. This was well over a year ago, I think now. So they've got cash on a balance sheet, 22 million, market cap 70 million, growing sales, growing profits. So again, good time to be looking at CML Micro.
Yep, we like cash as well.
Yep, exactly. And they've got plenty of it. So that on quality results. That's it from me, Andrew. Is there any others that you've spotted?
Yeah, I'll tell you what. There were a few little bits. It was all quite itsy bits. There was nothing I think that was going to move the dice, as they say. I say part of it is the background of this market is so difficult to move the dice. But anyway, look, the more importantly, I'm off to Cornwall for July. So I may do some podcasts with you, Phil. I may get others to do it just for a change. We'll just play it by ear, see what the weather's like, see if I'm out on the golf course. We may just try out a few new formats and things. But in the meantime, if anybody's got anything they want us to talk about, if anybody's got any comments about what we talked about, anybody's got any comments, full stop, we love to hear them. Please do. But we'll call it a day again. Quite a nice short podcast. Well done. Thanks, Phil.
Okay, take care, Andrew.